morning and welcome to this week's edition of the Bourse Report. I'm Carissa Gobin, an investment analyst at Bourse, and today we'll be looking at the financial performance of two companies in the manufacturing sector, Unilever Caribbean Limited or UCL and National Flour Mills Limited or NFM for their respective fiscal year periods ending December 31st, 2025. UCL performance was supported by stronger revenues as well as gains associated with restructuring and divestment activities. And meanwhile, NFM experienced lower earnings driven by higher taxation expenses. So firstly, let's move on to Unilever Caribbean Limited or UCL. UCL reported a total earnings per share of $1.63 in fiscal 2025, growing 48.2% year-on-year from $1.10 in fiscal 2024. This total earnings per share reflects contributions from continuing and discontinued operations. EPS from continuing operations declined 16.7% from 90 cents in fiscal 2024 to a current 75 cents in fiscal 2025. The remaining 88 cents was generated from discontinued operations as the group recognized a one-off gain from divesting its ice cream business and laundry brands. Revenue advanced 14.7% to $196.1 million, and profit before tax declined 15.4% to $29 million. Overall, profit for the period, which includes profit from discontinued and continued operations, advanced 48.6% to $42.8 million in the current period. Taking a closer look at UCL's revenue trend, there has been some volatility over the years, which is the expected outcome given the significant reorganization to UCL's business model over the past few years. Revenue rebounded from fiscal 2024 of $171 million to a current $196 million, growing 14.7% year-on-year. So top-line performance was actually driven by reported growth across all operating segments, with the group's largest segment by revenue, the beauty and personal care segment, growing roughly 16% year-on-year. So going forward, there should be some degree of revenue stabilization, reflecting a more consistent performance across the company. Moving on to UCL's profit margins would have improved steadily from 2021 to 2024, reaching peak levels in 2024 before moderating in 2025. Gross profit margin declined from 49.2% in 2024 to 46.0% in fiscal 2025, driven by faster growth in cost of sales relative to revenue. Operating profit margin similarly was down from 19.6% to 18.7%, and profit before tax margin stood at 14.8%. UCL trades at a price of $13.94 and offers investors a trailing dividend yield of 8.6 times, below the sector average of 10.4 times. So it should be noted that UCL's PE ratio, excluding discontinued operations, currently stands at 18.6 times. It also offers investors a trailing dividend yield of 39.2%, well above the manufacturing sector average of 11.4%. This dividend yield is seen as highly inflated given the special dividends declared over fiscal 2025. This elevated payout to shareholders is largely driven by one-off proceeds from asset sales, particularly from its ice cream business and laundry brands. Going forward, the dividend yield should normalize after the special dividends are accounted for. The recent reorganization of UCL's business model paves the way for more normalized operations, particularly in terms of earnings and dividends going forward. So on the basis of higher revenue and attractive dividend yield and the expectation of normalized performance, Bourse maintains a market rate rating on UCL with a stable outlook for the time being. Moving on to National Flour Mills or NFM. NFM reported an earnings per share of 36 cents in fiscal 2025, down 5% year on year. Revenue increased modestly from $523.4 million to $540.5 million, just up 3.3% year on year. Operating profit increased 8.3% to $69.7 million, and overall profit after tax declined 5% from $44.2 million to $42.0 million. This was driven by a 44% increase in the group's taxation expenses. Revenue for NFM rose steadily before declining in fiscal 2024, with a decline of 9.3% to $523.4 million, as UCL would have passed on the benefits of lower input costs to reduce consumer prices. Revenue then rebounded from fiscal 2024 to $540.5 million in fiscal 2025. According to the company, the increase in revenue was supported by the relaunch of its Ibis flour brand and growth in its feeds division. Moving on to NFM profitability margins. So margins would have increased steadily over the years. Gross profit margins grew from 30.8% to 31.2%. Similarly, operating profit margins grew from 12.3% to 12.9%, and profit before tax margin currently stands at 12.8% in fiscal 2025. It remains to be seen whether margins can be sustained given ongoing geopolitical tensions, which have contributed to higher global grain prices year to date. And this could potentially translate into higher input costs for NFM in the fiscal quarters ahead. NFM trades at a price of $1.45 and trades at a trailing PE ratio of 4.1 times, below the manufacturing sector average of 10.4 times. NFM offers a trailing dividend yield to investors of 8.3%, below the sector average of 11.4%. On the basis of modest revenue growth, improved margins but tempered by higher taxation expenses and global economic uncertainties, Bourse maintains a market weight rating on NFM with a watch outlook for the time being. And that brings us to the end of this week's edition of the Bourse Report. For more information, please give us a call at 226-8773 or email us at info@boursefinancial.com. Thank you for joining us, and we'll see you next time on the Bourse Report.